All right. Good evening, everybody. Terry from Epic Real Estate, where we show people how to invest in real estate with an emphasis on retiring early. Now, you don't have to retire early. You just get the option to. And having a life of options is really a life of freedom. And that's what this show is all about. That's what Epic Real Estate is all about. And today I want to give you a housing market update and let you know whether or not it's time to finally sell your real estate. Because you probably know, if you've been around here at all, for any length of time, you know that I am a buy and hold forever. It's my favorite holding period is forever. And but maybe it's time to sell. Who knows? So we're going to look at that. But if this is your first time here, really glad that you found us. If you like what you hear, make sure you hit the subscribe button before you go. And if this is not your first time here, welcome back. And thank you for sharing this with your friends and family. I really appreciate that about you. You're the absolute best for doing that. So thanks again. By the way, if you'd like to get started investing in real estate or jumpstart your existing efforts, investing efforts, I put together a free training just for you, and you can find the link below in the description, or you can just go to mattsfreetraining.com. Now, that's specifically for people that are looking to get their first deal done, or it's been a while since they've got their next deal done. So that's especially for you, mattsfreetraining.com. If you'd like to work together one-on-one, you go to reiace.com and then fill out the little application there, answer a few questions, and then we can pick the time to hop on the phone and brainstorm some ideas around your investing in your real estate endeavors. Alrighty. So is it time to sell? You know, we've had an amazing ride over the last couple of years. Actually, the last decade, I guess, maybe even 14 or 15 years. You know, typical real estate cycles, they go in 7 to 8 year cycles. And here we are almost having doubled a cycle of constant and steady appreciation. I mean, even if you purchased real estate just 1 year ago previous to that, and you still own it, you've made money. You're up. It is, but is it time to actually cash out your profits now? That's the big question. Okay, so I'm going to let you know what I think. But first, I just wanted to take you through and let's look at the market. Let's look at and see remind ourselves what the market is actually doing, because I've made a lot of predictions over the last year or so. And I don't know if they've changed it all, but I want to kind of go through this so you have some context as to where we are. And this is from a slide presentation I just did recently for an advanced group of my students to kind of give them an idea of how to look at the market and what to look at and how to make their own decisions. So it really comes down to supply and demand. That's pretty much what runs the market, regardless of what the product or the service is, right? So if the supply is high, prices are low. If supply is low, prices are high. And then conversely, if demand is high, prices are high. If demand is low, prices are low. So supply and demand, they just kind of work together like this. And so let's look at the supply. I mean, when it comes to supply, we're talking about housing, right? So houses represents the supply. And so if we look at history here, you know, just back in this last year or so, I thought this was supposed to be a slide showing the history of like 20 years or so, but this is just a 1 year slide. But you can see we are at an all-time low. You can take my word for it. If we were to go back, the left side of this graph goes way, way up. But yeah, we're at an all-time low. Supply is really low, and I think we're going to be here for a while. You know, there is a study that this is from Forbes that they released a while back, about middle of last year. And it says the housing shortage is worse than ever and will take a decade of record construction to fix. And so what do they mean by that? A decade to fix is not just some number they pulled out of the air. They actually looked at it, and I pulled this right here. These are the new housing units started in the United States, and this is seasonally adjusted annual rate. But if we look back right here at the peak of 2006, right there in the middle, where the very peak of new homes being started, being built. So that right there was the peak. And then you can see once the market crashed, new housing starts crashed right along with it to a really, really low amount. Whereas that was just 500,000 new housing starts a year then, when it was over almost 2.5 million, right? So then you can see that it slowly crept up over the years, but very, very slowly. And what this report here is saying, that this peak right here at 2006, we needed to maintain that building rate all the way up till now to 2022, just for our market to be normal. And for us to fill that gap, it's going to take a decade to do so. So right off the bat, what that's telling me is we don't have enough houses, and it's going to be a while before we catch up and have enough houses, because we're in a strong seller's market. And what that means when you're in a strong seller's market is when there's just there's more buyers in the market than there are houses available. And right now there's not very much inventory. And that's pretty much a national thing. And typically real estate is a local thing, and you can't really say that because real estate is so local. But nationally, the inventory is really suffering. There's just not enough houses for the people that we've got out looking to buy houses. And according to this in this report and this graph that you can see right here in front of your eyes, we're not going to meet that demand for a very long time. But let's continue to look at supply. Right here on the far right, we're not quite at the all-time high, but we're starting to build. The builder confidence is starting to increase, but it's still pretty cautious. And this is why right here. And even though the builder confidence seems like it's going up and we're ramping up to start building more houses, there's this that you got to look at. This is from Bloomberg. Building a home in the U.S. has never been more expensive. So you can see there on the left, copper price is pretty much at an all-time high. Cement and concrete to build housing is pretty much at an all-time high. Lumber was at an all-time high. It's come back a little bit, but historically speaking, it's still significantly high. And so with the materials being so expensive, what that is saying is that they got to build more expensive houses because they have to be able to sell them for more. I mean, they wouldn't be very good builders if they sold houses. They paid for these expensive houses to be built, and then they sold them for less than what they were worth. That would be ridiculous. And what they're finding is that it's a real challenge in that kind of middle class type house between, say, $300,000 and $500,000 houses, even up to $700,000 houses. To build those houses, they're getting to a point where they can't price them high enough to where it would actually make financial sense for the buyers. And so people, they're just not building those houses. So what they're building more of are the luxury homes. So the luxury homes are being built, and that's where all of these materials are going. And that's where this builder confidence is really happening, is in, your $1 million plus homes, because only then at that price point can they actually pay for these rising costs. So that's the supply. So we've got this supply. We've been at this huge deficit for a really long time. It's going to take a decade to catch up. And even though builder confidence is rising, it's not rising at the levels that we need, not to meet the demand that we have out there for the middle class average American. All right. So the demand. So if we know that the supply, if we know the supply is low, we know that's going to support prices. So prices are going to continue to go up based on just the supply. Now let's look at the demand. And so the demand is represented by people, right? And so the population is continuing to grow, despite what you might hear, the slant that you'll hear from the news on how the population growth is going, because percentage-wise, year over year, the population growth is falling. As you can see right here, it's represented by that orange line going down from left to right, going down very sharply, really. This is like over what? Oh, this is like over the last 200, almost 300 years, right? So it's decreasing in percentage of growth. But as you can see, the blue line represented there going from left to right is still rising. And the projections here are that it's not going to slow down. So although the percentage of growth is declining very rapidly, the population growth, the number of people, is increasing pretty rapidly. And the reason being is because if you took, say, we just looked at, say 1960, and we were doing 19% was the year over year population growth. So that was 19% population growth at a number right around 180 million people in 1960. So if we go over to 2000, we've dropped 6%. So in 40 years, our population has dropped 6% down to 13%. But see, that's 13% of basically 275 million. So although the percentage dropped, it's still a larger number, that 13% of 275 versus the 19% of 175. Okay. So the population is continuing to grow. So the demand is growing. And when the demand goes up, what do we know about that? That causes the price to go up as well. So if we look here, though, specifically about our population, these next 10 years ahead of us are going to be critical because it's when the millennials are going to be between the age of 30 to 39. And that's a very significant number because this is when people are buying their first home and when they're moving out of that first home because they've made a few bucks and they want to upgrade and they're going into their second home. So the demand is going to be really big in the next 10 years. And if we kind of look at how the population is broken up per generation, if we look at the millennials, the yellow number right there, it's 82.22 million people. Right there, if you go right to the peak and then go 2 bars to the right, that's right around the age of 31. And that 31 years old is a significant number because that's the average age of the first-time home buyer. So we're not quite at the peak of the millennials hitting the age of 31, but after the next 2, 3, 4 years, the biggest portion of our population in the United States is going to be passing through first-time home buyer age. And that's going to really drive the demand. There's going to be a whole lot of demand over the next few years. And then if you look right after, the portion of the population doesn't decrease too much. And then you got Gen Z right there behind them, right there, you can see. So what that's saying is there are enough people walking the planet right now to support your real estate investing for the rest of your life. So the demand is already here. It's built in. And then when we come up here, we already know that the supply is super, super low. So that's a formula or a recipe for consistent, steady growth. And this has been my position on real estate for so long that we are not going to experience a crash, at least not based on any of these fundamentals that I've shown you. But I've always talked about the one wild card, the one little factor or variable we have to watch out for, and that's going to be interest rates. So here's the snapshot of the historical 30-year mortgage rates, and you can see how the rates over the last since 1983, it looks like where they hit their peak right around 18.63%. They've continually fallen and fallen and fallen very steadily, and here we are right around, I guess, 3.5% in today's market. And so that's what we really need to watch. So we got to turn to current events, and the current events here should be very, very concerning. So let me switch over to the current events I pulled up for you. And we've got this right here. All right. So just last week, 2 weeks ago, January 26th, the Federal Reserve points to interest rate hikes coming in March. So the Federal Reserve on Wednesday provided the clearest hint yet that it could start raising interest rates as soon as March. So with inflation well above 2%, and this is what's causing it, and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate, the central bank said in a statement that concluded its 2-day meeting that week. And Federal Chairman Jerome Powell said asset purchases also are likely to halt in March. And the central bank released a paper outlining principles to start significantly reducing the bond holdings on its balance sheet without indicating a specific time frame. So we've known this is going to be coming, right? But we know what the inflation has done, and it's kind of accelerating this. The administration and the Fed, they've got to get a hold of inflation. Because, when you're going to the supermarket, you're going to the gas pump, things are more expensive, right? So this, as far as the real estate market and whether or not it is a good time to sell. Because right now, our 30-year fix, as I'm recording this, the 30-year fixed mortgage is 4.238%. Okay. So if we were to take this 4.238% and raise it, the rumor is there's a pretty good consensus that as of that last Fed report, that we're going to be raising the interest rates by 25 basis points. So that's 0.25%. So if we have 4.23% here on a $300,000 loan amount, actually that would be, let's do 400. What would that do us? Okay, so it's 4.22%. This will kind of pick a little bit more of a realistic number. Not too many $300,000 houses floating around anymore. more. I guess in the Midwest and the South, you got a chance at something like that. But if you're on either of the coasts, pickings are getting really slim. So 4.224%. So if I come over here just to a calculator and we can see 4.22%. So our mortgage payment with the 20-year, the mortgage payment for $400,000 loan amount is $1,961. Okay, so $1,961. So if we raise this 25 basis points, that's going to take us to what, 57. So it took us to 2,043. So pretty much almost $100, I don't know, $80 more per month. So if you're right on the brink, that $400,000 house, well, that's a loan amount. So the $400,000, so 20% would that be a $500,000 house? Yes. So that'd be a $500,000 house. They had to put some pressure on me with the math there. So a $500,000 house. So if your affordability, what you're approved for at the bank was a $2,000 loan, right? So at the current interest rate, you can afford that loan for the bank. But once we raise this basis points in March, you're not going to be approved for that same house. And so what that does is it brings the demand for that price point down a little bit. And we start bringing down the demand, and although we have the people, but their ability to buy starts being cut, that's going to cause prices to come down a little bit. Okay. So they kind of go hand in hand. And it's not a direct correlation, and it's not, well, it somewhat is, but it's not, it doesn't happen immediately, right? The market's it's not going to crash in March, but there will be adjustments made. But here's something that you really need to be concerned with. And this doesn't concern me that much. It's normal. And we're all kind of expecting it. And I don't think there's any cause for alarm, but they are suggesting that there could be up to 7 rate hikes this year. So if they raise 7 rate hikes 0.25%, or excuse me, they raise the interest rates 0.25% 7 times, that could cause a significant impact, right? So here's the one thing that we might going to be really concerned about, though. There's a couple things that are coming up. Well, this just happened. The payroll shows surprisingly powerful gain of 467,000 jobs in January, despite the Omicron surge. So they were only expecting, right here, non-farm payrolls rose 467,000 in January, almost 500,000, when they were only predicting 150,000. So that was huge. And so more people had jobs, significantly more. And that feels like it could be a really good thing, right? Well, it is. I mean, we want more people to have jobs. We want people to return back to work. So that's a great thing. But what that actually signals to Jerome Powell is that the market could be a little healthier than he thought, and it could possibly withstand a higher interest rate hike in March. So not just 20, maybe 50 basis points, a whole 0.5%. So that's a big concern. And then, so what that would do to our mortgage rates, that would be another, right here. So that would be what? 25. So it'd be what? 70, 82%. Don't comment if my math is off, but you're getting the point, right? So that takes us up another 200. Another $100. So that right there would now take that $500,000 house and change its monthly payment by $200. So that could be significant. That could have an impact directly on the housing market. And that could be something that causes some concern. So prices are going to come down a little bit. So is this a reason to sell? I don't know. Let's keep looking at it. But with this job report is causing some fear of a 50 basis point Fed rate hike and what that says about the future of the stock market, obviously, but that's also going to directly impact the housing market. So that's something we want to really watch. But here's something else that's coming up this Thursday. Here we are on Tuesday, February 8th. And so just a couple days, there's a number that we're going to need to watch because that could almost cement this 50 basis point hike. And that is the CPI. And if you're listening to this on the podcast, that's actually probably happening today, the day that this is released. So the consumer price index rose, or probably jumped 7.3% in January from a year ago. And that's the largest annual advance since early 1982. So when the CPI numbers come out on Thursday, in a couple days from now, if we're 7.3% or higher, that's going to signal that we need to that inflation is really getting out of control, and have to make potentially make a more dramatic move in those interest rates. And so 50% basis points could almost be okay. So supply and demand, I think we're all in a really good spot as far as real estate investors, but the interest rates have always been the big variable, and we've been kind of spoiled for a really long time as they come lower and lower and lower. So we want to look at that, or we want to really pay attention to the current events and what's happening, and how that's going to impact our buying power, and whether or not that factors into our decision to sell our properties or not. Okay, so here's something else that I want you to kind of look at, and that's what a lot of people, real estate investors, aren't really. Let me try and find the slide here real quick for you. Oh, let's see. Here it is. There's that. There's that. And let's see if I have it on here. Oh, hopefully I do. Here it is. So your year over year rent increases. So the prices of houses over the last several years have been rising pretty rapidly. And but the rents really haven't. Not until just last year, the last 12 to 24 months, have rents really started to start trying to catch up with the prices of real estate. So Houston, you can see, is up 24.3% year over year. Santa Ana, California, 27%. Tucson, Arizona, 32.5%. Jacksonville, Florida, 35.5%. And Las Vegas, right here where I live, 42% year over year rent increase. So if you're a landlord, that was actually really good news. Now, you might not have felt it yet because you haven't had a lease renewal yet, but it's coming. And that can certainly offset any sort of interest rate hikes, right? And that would certainly stay well ahead of any increased mortgage payment, particularly if you have an adjustable mortgage on your property. Okay, so is it time to sell? I'm going to say no, absolutely not. It is not time to sell. But there are a few scenarios where I would say yes. And I'm going to give you those scenarios in just a second. But here's why I would not sell. Based on supply and demand, your real estate will become more and more valuable over time. And further, what most landlords don't realize is that as prices have risen, so have these rents. And as an income generating real estate investor, a cash flowing real estate investor, that's really important to be aware of. And if rates rise, the payments are going to rise, right? So fewer and fewer people will be able to afford to buy a house. And what that's going to do, it's going to drive the demand toward rentals, likely even more and up, and drive those rents up even further. And you don't want to give up your income. You don't want to sell for cash and then not have a place to put it to maintain your income, particularly with inflation doing what it's doing to just eat up the value of that cash. So the value of your real estate is your hedge against inflation. And if you don't plan on selling it, who cares what happens to the price, where the prices go up or down? What you really want to focus on is the income that your real estate is producing. And your rental income is what's going to support your lifestyle, but it also is a hedge against inflation, because as prices rise in the grocery store and prices rise at the gas pump, prices are also going to rise when it comes to rent, when it comes to where people are going to live. And if you are the landlord, that means you have control over that, and you have control over income as things become, or I would say as things become more expensive, but it really means as your dollar becomes less and less valuable, right? So you need to bring in more of those dollars to maintain the lifestyle that you experience right now. So when is it time to sell, though? Like I said, I'd say never, but there are some exceptions. But here's why I say never. If you go to, I don't know, if you ever find a real estate investor that's been in the business for 20 years or longer, if you go to the RIA meeting or a meetup group and you kind of see the old guy standing in the corner and it looks like he's got some experience under his belt, go ask him, if you were to start all over again, what would you do differently? And without a doubt, almost every time you're going to get some form of this answer where they'll say, I wish I would have bought more and sold less. Almost every real estate investor of 20 years or greater would have those same sentiments because they know that they would be in a better position today had they not sold as much as they did. And so you want to take this opportunity to learn from other people's mistakes. As Mark Twain said, because you won't be here to make them all on your own. So embrace that and understand that, and don't let the fluctuations of the market impact you emotionally and make a decision that you would potentially regret and likely regret in the future. Okay, so, but here are the scenarios of where I would consider it acceptable to sell. It's acceptable to sell if, one, you need the money to survive, right? If you're really hurting, and there are a lot of people hurting right now, and for various reasons. But if you need the money to survive, then and use your asset, take some of that profit that you've been able to generate over the last several years, and support yourself. Now, let me say, this is not for a life of luxury, no, but to survive. Okay, it's not selling to thrive; it's selling to survive. That's one scenario where I find it acceptable to sell. The second one would be if you disagree about the supply and demand in the real estate landscape. If your idea about real estate somehow changes to where you think, you know what, people, I don't think they're going to want to live in houses anymore. I don't think they're going to find a roof over their head that important. So if your thesis about real estate changes, then okay, go ahead and sell. The third thing that you might want to sell is if you're going to upgrade your portfolio with better property. So if you're going to sell, say you picked up a few properties in those C markets and they've become maybe management headaches for you, and you want to upgrade and move into nicer neighborhoods or just a different part of the country even, or maybe bring it closer to home if you're investing foreign or remotely, that might be a reason. Okay. I would be okay if you took your money and the profits from one piece of real estate and put it into a nicer or better performing piece of real estate. That would be an acceptable reason to sell. And then the fourth thing would be is if, your property is not generating income for you. If you purchased for speculation purposes, just for appreciation, this might be a good time to sell. The interest rate hikes have almost been guaranteed. They've certainly been strongly suggested. We know where the inflation numbers are. They've got to do something to curb that, to start bringing it down. And that's really the only tool that they've got, is to increase interest rates. And so if we continue to increase interest rates, if they do those 7 hikes this year, we know that's going to have a negative impact on prices, and you're going to lose that profit that you've built up. So if you've purchased real estate for the sake of speculation and just holding on to it to wait for it to appreciate, you've done really well for yourself, and this might be a good time. Now, the government has been known to change their mind here or there, and they just might do that. But if they do keep their promise, then this probably would be the best time to start thinking about selling. But if your property is producing an income, you're going to want to hold on to that, even if the prices drop, because that income is going to be your hedge against inflation. That income is what provides your livelihood. Alrighty, so that's what I want you to really think about. Supply and demand, I think for long-term real estate, there's nothing safer. There's nothing more certain out there. I mean, we've got real estate, food, and oxygen, right? On water. Those are the 4 necessities of life. And people are always going to need those, and they're always going to pay for those. So you've got one of them in real estate, and we've got more people walking the earth than we've got houses, and we're not building them fast enough to keep up. So the supply and demand dynamics are in your favor for as far as I can see when it comes to real estate. The big variable is when it comes to the interest rates. So that's what you want to watch. The job reports were good, so that's saying that the economy is recovering. The inflation is still high, so that means that's saying that the Fed actually has to do something to bring it down. And so interest rate hikes are almost for certain. To some degree, we don't know exactly how much, but we know they're coming. And so you want to watch your speculative investments. All right. So if you invested for profit and we're banking on the appreciation, this might be the peak. I would probably, if it was my situation, I guess that would, if I I would start thinking about it right now. All of my income properties, and I'm not selling a thing. In fact, I'm going to try and buy more before they increase these interest rates too far to where it makes cash flow a little difficult. So think about that. If you've got the means to go out and get some more, it might be a good time right now. In fact, I'm picking up another property here in Vegas just because of that, because I want to go ahead and grab these low interest rates and lock that in before the interest rate hike in March. Alrighty. So if you'd like to dive deeper into your real estate and get started and go look for that first deal, I put that free training together for you. It's at mattsfreetraining.com. You can find the link below in the description. And then if you're a little bit more experienced and you've got a couple deals under your belt and you want to maybe work together one-on-one, you can go to reiace.com. And then just answer a few questions there. We'll hop on the phone and brainstorm some ideas about what working together would look like for you. And if it's a good fit, we'll go ahead and take the next step. But if it's not, that's fine too. We can give you some additional resources that might be a better fit for you. All right. So that wraps up the Epic Show. If you found this episode valuable, who else do you know that might too? There's a really good chance that you know someone else who would. And when their name comes to mind, please share with them and ask them to click the subscribe button when they get here. And I'm going to take great care of them. All right. God loves you. And so do I. Health, peace, and blessings to you. I am Matt Terrio, living the dream. Take care.